So the IRS finally started accepting your 2020 tax return on Friday. So on this week's program, we're going to talk a little bit about some of the things that are new for 2020 in the tax return that you are in the middle of starting to maybe get organized or maybe even starting to file. So we've got some things to talk about on the program as it relates to your tax return. Plus, we've got some interesting stats about the markets, about the economy, and about our debt as a country that we want to share with you as well. All that here on the program Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So, quick update before we get to financial topic stuff. First and foremost, of course, happy Valentine's Day. If you're checking us out on YouTube, you see that, yes, in fact, we did get our act together today to wear something red. Sort of forgot that on Friday, or had that thought, and then, I don't know, but sometimes you have these thoughts and you're like, oh, that's a really good idea, and then goes out the other side of the brain that quickly. So showed up on Friday, everybody else was in red or wearing red, but hey, I remembered it today. So we got the red tie on for our YouTube audience. And along with that, last week we mentioned that we were taped. So this week we're coming to you live here on Sunday morning. It is in fact a rainy, cloudy, as I look out the window, rainy and cloudy out there today. But last week we were taped because we were over in Melbourne running a marathon over there. Unfortunately, it wasn't exactly the way that we wanted that to go, because the thunderstorms and tornado watches came in about halfway through the race, and they called the race in the middle of it. So now, granted, I haven't run a ton of marathons, but that's sort of the first one that I've heard of, like halfway through there, like, okay, we're done, come on in, and whatever it is your time is, that is it. So anyway, we're going to try and give it another go down in Stewart on a couple Sundays from now. So we'll have to be taping a couple of Sundays from now. We'll let you, of course, know. And then, if you recalled one of the topics last week, of course, it was the Super Bowl indicator. So I'm sure our listening audience on 96.9 The Game is very excited about the Bucs win. Of course, all audiences should be excited about the Bucs win, because if the Super Bowl indicator that we talked about last week on the program actually rings true, and remember, it had been inaccurate for the past 5 years, so maybe this year it's bound to be accurate, right? Team from the NFC wins, that's a positive sign for the market. So we'll see how all of that plays out. So, but certainly go Bucs indeed. So I'm reminded of this old Latin expression today, caveat emptor. And do they teach Latin anymore? I had it in high school, but that was 30 odd plus years ago, and so maybe longer than that, actually, now that I think and do the math. But anyway, do they still teach Latin? I'm not sure. Anyway, caveat emptor, right? Buyer beware. That's an expression, obviously, that's been around a long time, and we think that that can actually be put on many 401ks these days, especially when you sign up for sort of the newest rage, if you will, whereby so many 401k platforms now have built-in advisory services into them. And this is where kind of the buyer beware thought process comes in. The problem is that there's often a charge associated with these services inside of a 401k. That charge can often be 0.25% to 0.35% per year of your balance, and ultimately that can certainly add up to a sizable additional cost that your 401k is incurring without really having any additional value add. Because what's happening is that the program is simply taking a look at the answers that you've given it and generating an asset allocation that ultimately dovetails into a much more conservative mix than it really should be. Let's take a look at a specific example that we saw just this past week where someone came in and we were talking with them. They had come into the office for the first time. And so we always ask, just as we do any of our clients, existing or new, about their 401k, because our point is whatever you do, you want to make sure that from an investment perspective that you are in fact having those investments all sort of work together in a holistic manner. So it's not enough to just say, oh, I've got the 401k and it's got X number of dollars in it, but you really need to drive down into the details of it and take a look at exactly what it is that you are doing in terms of ultimately the holding. So during the course of the exercise, we kind of like to look at that information in much deeper information. So at first blush, this particular person had like 7 different funds in the 401k, and so it looked like they had a pretty broad-based allocation until you realize that it wasn't like they were directing money into 7 different funds. What was happening is that there was an umbrella called Target My Retirement that ultimately was driving the investment allocation. And so the Target My Retirement was based upon a pop-up that they had completed when they first enrolled in the program, except the problem with it is that when you looked at the actual funds, you realized that the fund mix was 45% on the bond side of things. And that's a pretty heavy bond component, especially for a 53-year-old with their retirement account. So from that perspective, it just didn't make sense. So here's the buyer beware, the caveat emptor, if you will. Make sure that you're checking out that underlying investment mix, that underlying investment allocation. In this particular case, it's a 50-year-old still 12 years away from retirement. In terms of what she told the computer, the reality is that that computer then made the allocation to be much more conservative, so that by the time she got to 65, it would basically be an income-only portfolio without any growth whatsoever. So what you need to do is, those are certainly some things to watch. Be careful if you're signing up for a particular service inside your 401k that it doesn't steer you to be too conservative too early. So what can you do to make sure you're avoiding that? First of all, don't hit the easy button. You've really got to take a minute and really dig into the investment allocations or the investment options that are available in your 401k. In this particular case, there was actually like 30 different investment options that were available that we were able to use and create a mix that ultimately worked well with some of the other investment approaches that we were using. So it's important to make sure that all of those tie together, and make sure that you're taking time to review the individual investment options that are available in your 401k, because oftentimes what we find is that there's a better way to sort of match up and take a more holistic approach to your investments sort of across the board and save money, because you don't have to then pay the service in the 401k, and ultimately pick those individual funds inside the 401k. So certainly something to consider there in terms of your retirement. We'll be back after these messages. So finally, the IRS has opened the floodgates to accept 2020 tax returns. The filings season had gotten delayed until February the 12th, so obviously that was this past Friday, and so now the window has officially opened up. 2020 is certainly going to be a year where you're going to see a lot of changes on your tax return. Beyond the Bitcoin question that they are asking on everybody's return, yes, in fact, you will have to certify on your 2020 return that you're not trading in cryptocurrency, because if you are, they kind of want to know about it because they want to get the tax revenue off of that. So beyond that, though, we've got a handful of specific items for you to be aware of as you start to organize your documents, or maybe you're really ahead of the game and starting to actually do your tax return itself. So welcome back to Dollars and Cents, where we help you make sense out of all of his life's decisions involving your dollars. Central Florida's longest running radio program, coming to you here on the News Radio WFLA Orlando network. Also one of the top 25 financial planning podcasts on the World Wide Web. My name, of course, Joel Garris. I'm with Nelson Financial Planning, where I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. Our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So lots of changes, obviously, for the year 2020. One of those that immediately springs to mind is the Payroll Protection Plan program, right? The PPP stuff. Now, this was loans that were available to businesses to sort of help them get through the pandemic, allow them to continue to pay salaries, rent, light bills, things like that. And what's interesting, just about this one particular item, we actually saw this, or the tax treatment of this, change 3 different ways during the course of last year. But here's the bottom line. On your PPP loan money, it is a forgivable loan. But what's really important about that is that not only do you not have to include that loan amount as income in your business, rather you can also deduct the expenses that loan money was used to pay for. So in essence, sort of gathering a double deduction on that one. So pretty powerful stuff when you start to kind of look at exactly how that PPP money will flow through on your tax return. But be aware, you don't have to report it as income, and you do not have to avoid the write-off of the deductions. You can do it both. Not report the loan as income, and also continue to take the expenses that you use the loan for as deductions on your tax return. Next is unemployment, and this is kind of unique because I think last year, during the course of the pandemic, I think a lot more people found themselves collecting unemployment than might not otherwise have ever collected. Many people were collecting unemployment for sort of the first time in their lives, and one of the things to remember about unemployment compensation is that, sadly, it is taxable as income. So you're going to be getting the tax document. Make sure you put your unemployment compensation on your tax return because it is taxable and you have to pay tax on that. Flip side, the stimulus checks, not taxable in any way, shape, or form. Even if last year you had a great year and your income went through the roof, you still don't have to give back that stimulus money. The stimulus money was based upon your 19 return. If you are no longer eligible for the stimulus check based upon the 2020 return, the good news there is you don't have to give it back. It's free. You do not, well, nothing's free because, ultimately they're borrowing money to do it. But anyway, I digress. You don't have to pay it back. If, on the other hand, though, you didn't get all of your stimulus check, this is where you're going to want to really take a moment and track down, okay, well, did I get the full 1,200? Did I get the full 600? What did I actually get? Because if you got less than that, then there's an opportunity for you to claim more of that or all of that if your 2020 income tax return shifted the numbers enough to the point where you were eligible to get more of that stimulus check. So it's one of those things that's certainly new and unique for 2020 where you want to bring that into the mix on your tax return because you may find that if you didn't get the full amount, then you can get more. If you got the full amount, it doesn't matter. It's yours to keep no matter what. So make sure, though, you're aware if you didn't get the full amount, there's a recovery rebate credit that you can claim on your 2020 return in order to potentially get the full amount of that depending upon how your 2020 tax return worked out. Obviously, the 2020 income would need to be lower than the 2019 in order for you to get more of those stimulus checks because those stimulus checks were based upon total income that determine the eligibility. Next up, sort of on the list in terms of tax changes, or this one's sort of actually been around for a while, but I think it bears repeating. If for some reason you wound up getting some debt forgiven as it relates to your principal residence, right? So this goes back to the 2008-2009 financial crisis, when Congress said, okay, well, because that crisis is so dramatic and affecting so many people as it relates to their mortgage and as it relates to their homes, then we want to be able to say to these folks, look, typically when someone forgives a debt, it is income to you in terms of the amount of the debt that was forgiven. However, as a result of the financial crisis in 2008, they said, okay, we're going to exempt if it's debt, if it's mortgage debt on a primary residence. That forgiveness of debt is not income if it is on a primary residence, and that in fact will be the case until the year 2025. Required minimum distributions, obviously those are back for the year 2021, much like we were saying during the course of last year. You have to go through the process of specifically turning that off if you did not want to take the required minimum distribution. Similarly, this year, you got to go through the process of turning it back on. If you shut it off for 2020, make sure it gets turned back on for the year 2021. Many financial institutions will not just do that automatically. So you've got to make sure that the RMD is sort of ready to run for the year 2021, because it is in fact back. Another COVID rule that deals with retirement accounts is for IRA distributions. With IRA distributions, you have the ability to pay those taxes up to $100,000 of money that you may have taken out of a retirement account during the course of 2020. You've got the ability to spread out the tax limitation or the tax implications on that over the course of the next 3 years. So make sure that you are aware of that option, because that option is a good option to have, because it can spread out that income tax liability on that over the course of the next 3 years. It also gives you the ability to pay it back over the course of the next 3 years. Another unique item for 2020 is charitable deductions. You can actually write off $300 of charitable contributions regardless of whether you itemize on your tax return. So it's like a frontline item, $300, $300 deduction. Make sure you take advantage of that. Most people typically will, give goodwill, or, well, it's actually cash charity to get that charitable deduction, but most folks will sort of give money here and there, and ultimately should certainly take advantage of that deduction. So make sure your tax preparer gives you that $300 write-off for charitable contribution. You can get that regardless of whether you itemize or not. So that's a big one. And then lastly, don't forget this, the 3 martini lunch. We've talked about it on prior shows. The reality is for 2021, 2022, you can get 100% deduction. So not on the return that you're doing this year, because that's 2020, but going forward, next 2 years, you can get 100% deduction on business meals in order to encourage support of restaurants. So be aware of that. You can go 100% rather than 50% on business meals. So those are just some of the big tax changes. We will slide to the break and pick it up on the other side of the break here on Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. So how many of y'all remember the segment on Saturday Night Live that was entitled Deep Thoughts by Jack Handey? Well, we've got some deep thoughts for you today, probably not nearly as entertaining as the Jack Handey version, but you're stuck with the Joel Garris version, I guess, on Sunday morning. We're not Saturday Night Live. We're coming to you here on Sunday morning. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on the News Radio WFLA Orlando network, along with 96.9 The Game. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out there. Subscribe to us on any of our social media or podcast channels. If you have trouble finding out where exactly our channel is, just go to our website, nelsonfinancialplanning.com. Upper right-hand corner, a bunch of different icons. Click on the one that looks most familiar to you, and you'll get immediately connected to us. So make sure you subscribe to us through those various channels. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So we'll get right into sort of our version of the Jack Handy Deep Thoughts. We've got some different things, some different stats that we saw about the markets, about real estate, about the federal debt that we want to kind of share with you and help draw some conclusions on some of the data that we see out there. So without further ado, we'll go straight to the markets. And this is one we've talked a little bit about before, but it does bear repeating. More new brokerage accounts, about 10 million, were opened in the year 2020 than in any other year. Obviously, with the pandemic trapping everybody at home, people were bored. The absence of sports for many months there, people again looking for something to do that might be a little exciting. Enter in these online trading brokerage online apps that are available out there, things like Robinhood, and then you also then have the social media component through the folks at like Reddit, and layer in on top of that, and this last piece is a very important piece, a market that has been going up steadily for nearly 12 months with no real volatility to the downside. You take that perfect combination and you wind up having a lot of bored people, a lot of people thinking the market only goes up. It doesn't, folks. Watch, volatility is normal here. And ultimately looking for something to do, which led to a huge amount of online trading accounts being open. The silver lining on that, and we hope that there is a silver lining on that, is that means that more people may be interested in investing, and we think that that is fantastic. Our fear is that what many folks are doing on Robinhood and the like is not really investing. It's really more speculative trading or just straight trading, and there's a big difference, and we've talked about this in prior shows, between investing and trading. We want folks to be investors, not traders. Being an investor is how ultimately you accumulate wealth over time. So the question also that raises is, the last time we saw this much of an increase in trading, this huge increase, it was the late 90s, where you had the first wave of the phenomenon of day trading. And so you have to think, okay, are we starting to see some parallels to sort of what went on? Because if you layer onto that the fact that there's a small handful of companies, the FANGs, that ultimately are driving like 80% of the performance of the market, and that's where a lot of this activity on these trading accounts that have all been opened up over the course of the past year, that's where a lot of the activity is. So is there perhaps a potential for history to repeat itself? That's perhaps one of our concerns in terms of where the market is and what's happening out there in the world at large, particularly when you consider this next statistic, which is the use of margin debt on the New York Stock Exchange increased to an all-time record of $722 billion. Now, let me explain what margin debt is. That's when you want to buy something, you don't have enough money to buy it, and you borrow money to do so. Stop and think about that. If that was a package of gum, it would be a really bad idea. But for some reason, when it's a stock, it's an okay idea? Question mark? I don't think so. And so anytime you see margin debt, people borrowing money to buy stocks and options and all that kind of stuff, the reality is that means that more and more people are borrowing money. There's a greater likelihood that there's some kind of a reconciliation ahead of all of that, particularly when the activity is concentrated in a handful of companies. So somewhat concerned about how much debt is out there, and particularly how much debt is out there in the hands of investors as they're borrowing money to make these purchases and these trades on these various apps. So be a little careful with that one, that is for sure. And then lastly, in terms of the markets, before we get to sort of the investor takeaways on this data, it is just how thin the markets are in terms of performance. If you look at the S&P 500, and we just look back to sort of the end of January, was hitting all-time highs at that point. So you got the S&P 500, 500 different companies hitting an all-time high, but if you peel back the layer of the onion, if you will, only 13 companies in the S&P 500, 13 out of 500, were hitting all-time highs simultaneously with the index itself. That to us says that's a pretty thin in terms of the breadth of what's going on in the market relative to what's going on an individual company basis. We'll say that statistic again. 13 companies out of the 500 were hitting highs at the point in time when the index was hitting highs. You'd like to see a little bit more breadth than that in the overall market. So what are some investor takeaways? Well, number one, be careful. Okay, there's a lot of interest in the market right there. If everybody's doing it, it's time to be cautious, right? Warren Buffett's got the expression: be greedy when folks are fearful. Be fearful when everybody is greedy. We may be kind of getting into that latter period of time, particularly when you kind of look at these debt levels, these increase in the amount of accounts, and ultimately just kind of how thin the market is. And so that gives us to the next sort of investor point, which is understand, if performance is concentrated in a few stocks, take a deep dive on your own individual portfolio to make sure that you don't have a high concentration in a small handful of companies. You really got to kind of do an analysis on your various investments across the board. That's one of the reasons why early in the program we were talking about we look at our clients' allocation in their 401ks and make sure that it is working in harmony with whatever it is that we're doing on our end. And the reason for that is that you don't want to see concentration among a handful of companies, because that undermines the diversification, and it also, I think, subjects you to much higher level of concentration in these small handful of names that have really been driving the market of late. So take a deep dive, actually look at the companies that you own and the percentages that your portfolio is in each individual company. If it starts to get above 3% in any one single company, then we would urge you to kind of start that process of maybe rethinking or rebalancing across the board. So next up, we'll shift slightly to what's going on in real estate. Got some interesting stats on that as well. Clearly a seller's market out there, considering the following statistics. As of year end, there was slightly over 1 million homes for sale at year end. 2 years ago, that number at the end of 2018, a total of over 1.5 million homes for sale at that point. And then if we go back just 10 years ago, you would find 3 million homes for sale. That's 3 times the amount of inventory versus what we have now. So fundamental laws of supply and demand, right? The reality is when you've got low supply, even the same level of demand is going to cause prices to go up on a regular basis. And then the next statistic, well, hold on for that one on the real estate side of things. We're going to take a break. When we get back from the break, we're going to hit the next statistic that we've got on real estate and give you some key takeaways for folks to be considering on that. So we'll take a break and then return here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. So continuing sort of the segment on the interesting stats, the deep thoughts, if you will, by Jack Handy, sort of our version of that, not the Saturday Night Live version, because after all, this is Sunday morning. And the stat we were saying before the break was just how much the inventory of houses has really shrunk from like 3 million in terms of the houses for sale as of 10 years ago down to about 1 million today. So obviously that's going to help drive prices pretty dramatically, along with the fact that this statistic, which is actually a good statistic, in that 37% of homeowners owe nothing on their homes. And So that's really a very good spot for that group of folks to be in. The problem, of course, with that is that means that 63% still have some type of a mortgage or home equity line on their property. And that's one of the things that we encourage people to try and eliminate that mortgage before they get to retirement, because can be a big part of your cash flow if it's still in existence once you get to retirement. So we encourage people to really try and do that. You've got super low rates right now, so there's an opportunity for folks to take their 30-year fixed rate mortgage and in many cases drop it down to a 15-year, and then with the savings that you're getting on the interest rate, not have that payment change a whole lot. Here's a specific example. If you've got $100,000 at 5% on 30-year fixed rate mortgage, that's going to be about $537 a month. If instead you drop the rate from 5% down to 3% and go to a 15-year mortgage on that same $100,000, you really only increase the payment by about $150 per month for that $100,000. So something worth considering, and one item that certainly folks would certainly be encouraged to be able to really do that with the goal of trying to make sure that the mortgage is fully paid off. So next up, sort of in this conversation about deep thoughts is, and some interesting stats, of course, is the deficit data. Now here's where things kind of get much more interesting, especially in lieu of kind of where how much debt has been amassed in a short period of time by the federal government. And sadly, one of the most important points on the side of the federal debt is that it has become a nonpartisan addiction these days, right? Going back over the past 20 years, George Bush in office for 8 years, the national debt under his 8 years increased by 86%, up to about $10 trillion. Next up, Obama also served for 8 years, and his increase in the federal debt was by 88% to the tune of almost $20 trillion. Trump comes in next, 4 years, not 8, but he was certainly on track to replicate what we saw in Bush and Obama, because in his first 4 years, the national debt increased by 39%, all the way up to $28 trillion. Folks, that's just a bad recipe when you don't necessarily have any checks or balances out there in terms of politics. You know, we see with like tax rates where the pendulum shifts back and forth, and ultimately we just haven't seen that on the debt side of things. And so both parties have really exploded the debt, and that could certainly spell trouble for the long term, particularly when you think about this sort of crazy comparison. So 2008, 2009, significant financial crisis. And we would argue that financial crisis probably had broader implications in terms of what the pandemic has had. If you think back to 2008, 2009, anybody that had a mortgage, anybody across populations, across economics, across jobs and sectors of where people worked, the mortgage crisis really erupted across the board. And so in a lot of ways, the 2008, 2009 really was a pretty dramatic economic impact. But yet, in response to that, the folks in Washington wound up generating stimulus of about $1 trillion, not even $1 trillion, 983 billion to be exact. And a huge chunk of that money was the TARP money that actually was paid back. If we sort of fast forward to today, the pandemic, we've sent out, the folks in Washington have done stimulus of about 3.7 trillion at last count, not including the next trillion or two that they're thinking about doing currently. And that's just a staggering amount, especially when you relate it to the size of the economy. So back in 2008, 2009, the stimulus that was done at that point represented about 6% of the total GDP. Today, so far, last count, not including anything else that they're talking about out there, up there in Washington, but that amount of stimulus so far has equaled about 17% of the economy. Folks, that's a tripling of the amount of money that has been put towards the stimulus. So it's just amazing and a bit crazy when you stop and think about these numbers and how dramatic or how much that stimulus has been. The only piece of good news on it, I suppose, is that with the crazy low interest rates, they can in fact borrow money at a much lower rate. Back 5 years ago, or should I say back 5 years ago, the average rate or the interest rate on debt that the U.S. government issued was right at about 2.3. Today, or at year end 2020, that interest rate was under 1.7%. That may not seem like much, but what it does allow you to do is it translates into the fact that you can borrow about 37% more today than what you did 5 years ago and still have the same interest rate expense as you did. So that's good, but 37% is not 3x the amount of stimulus that has been put in to the economy versus what happened in 2008, 2009. So great, it's low interest rates and you can borrow and have a lower interest cost, but at the end of the day, if you're doing triple the amount that what you did before, that's still going to ultimately be a cost that you have to catch up. So those are some of the stats that we look at and we say, this debt thing, probably need to start worrying about it at some point. With that, we will wrap it on up and get on out of here. Thanks for listening to this week's program here. This has been Dollars and Cents here on News Radio WFLA Orlando.